The Bank of Canada is trapped. They can't cut, they can't hold, and they definitely can't rise interest rates. Every single option they have leads to pain because this isn't just about inflation anymore. It's about credibility, it's about housing, and it's about politics. Over the last 3 years, the Bank of Canada has lifted interest rates faster than at any time in modern history, from 0.25% to 5%. The goal was simple: kill inflation. And for a while, it looked like it was working. Inflation fell from over 8% down to around 3%, but that last stretch from 3 to 2 has turned into the hardest part. And the biggest problem: shelter cost. The one thing that higher interest rates were supposed to fix. And now they're the thing keeping inflation alive. Here in Ontario, rent growth is at record highs. Vacancy rates are at near zero, and landlords are losing money on rentals because their mortgage costs have doubled or tripled. Meanwhile, nearly 2 million Canadians are headed into mortgage renewals over the next 18 months, many staring down payment jumps of $100 or even $200 a month. If the Bank of Canada cuts or even gives relief to homeowners, it could reignite inflation and spark another housing frenzy. If they hold rates steady, inflation might stay contained, but it also keeps households and small businesses suffocating. And if they raise rates again, it could tip the entire economy into a full-blown recession. Canada's GDP growth is flat. Job creation is slowing. Household debt is at a record highs. And the cost of living is rising faster than wages. The Bank of Canada is fighting a monster it helped create. Years of cheap money inflated one of the biggest housing bubbles in Canadian history. And now the fallout is everywhere. From Toronto condos that can't cash flow to Niagara families struggling to make ends meet, and to small landlords realizing their investments don't work anymore. And now everybody's looking at the Bank of Canada asking, what are you going to do about it? But the truth is, there's no good options. If they cut, the Canadian dollar could fall, making imports, energy, or even food more expensive. If they hold, Canadians keep breaking under the weight of debt. If they rise, the housing market could collapse. It's a nightmare scenario because no matter what move they make, someone loses. So the question becomes, what happens when the people who control the cost of money can't afford to make a move? So let's break this nightmare down. Option 1, cut rates. On paper, that sounds great. Variable rate homeowners could finally get relief. People could refinance at lower payments, and the housing market might even start to move again. But here's the catch. Every time the Bank of Canada even hints at cutting, demand floods back into the housing almost overnight. Buyers rush in, bidding wars return, prices start rising again, and when prices rise, rents follow. Renovations ramp up, customer spending ticks higher, and inflation reignites. It's a pattern the Bank of Canada knows all too well. We saw this during the pandemic. Cheap money fueled record borrowing, record prices, and record debt. If they cut too soon, that inflation beast could come roaring back. So cutting feels good in the short term, but it's a trap in the long run. Option number 2, hold rates steady. That's the path that they've chosen for most of the past years. Cautious, data dependent, wait and see. It sounds reasonable until you see what it's doing to real people. Every month that rates stay high, more Canadians fall behind. Businesses can't expand. Developers can't finance new housing projects. Consumers are maxed out on credit. According to Equifax, delinquencies rates are rising at the fastest pace since 2008's financial crisis. Insolvencies are up, savings are down. And the real economy, the one that employs Canadians, is starting to break. Small businesses' bankruptcies are climbing, housing starts are plunging, and the GDP per capita, when you adjust for population, is shrinking. So while holding might sound stable, it's actually a slow bleed option. Quiet pain spread across millions of households. Now, option 3, raise interest rates again. No one wants to talk about it, but the risk of another hike isn't zero. Because for the Bank of Canada, credibility is everything. If investors stop believing they can control inflation, the entire system starts to unravel. Think about it. Every bond yield, every currency trade, every mortgage rate in this country is built on the assumption that the central bank can and will get inflation back to 2%. Now, if that trust disappears, markets panicked. Bond yields spike. And what you need to realize is lenders raise rates on their own. And that's when you realize the bank doesn't even need to raise rates anymore, that the market is doing it for them. And yet, despite all of this pain, inflation isn't dead. Shelter costs are still up over 6%. Rents are still climbing. Groceries are still expensive. The bank's weapon, higher interest rates, is losing power because inflation now isn't being driven by shopping sprees or overspending. It's being driven by structure, housing shortages, energy cost, and government spending. And here's the kicker: monetary policies can't fix any of that. Meanwhile, fiscal policy, the government side, keeps spending. Deficits are growing. Provinces are rolling out housing incentives. Municipalities are continuing to rise interest rates. All of that keeps demand alive, even as the Bank of Canada slams the brakes. It's like driving with one foot on the gas and one on the brake. And there's another piece that people forget about. Every rate decision affects the Canadian dollar. If the bank cuts too early while the US holds rates higher, the loonie drops, making imports like oil and food more expensive. And that weaker dollar just feeds inflation all over again. So the bank isn't just fighting inflation, it's defending the value of our currency as well. That is the paradox. If they move too fast, the dollar falls. If they move too slow, the economy breaks. It's really a lose-lose scenario. And now we've reached the point that where even doing nothing is dangerous. Every month they wait, more Canadians hit renewal. More builders cancel projects. More renters get priced out. This isn't the soft landing anymore, it's a stall. And nobody knows where the runway is. Some economists are already calling this a policy trap because the traditional playbook doesn't work anymore. You rise rates, you risk a recession. You cut rates, you risk inflation. You hold rates, and you get both at once. So what does the Bank of Canada do now? They buy time. They talk tough. They use phrases like data dependent and measured approach. But behind the scenes, they know the pressure is building. And here's the truth. The longer they wait, the fewer options that they have left. The Bank of Canada is in a corner. And when the people who control the cost of the money are boxed in, it's not just a policy problem, it's a national problem. So where do we go from here? Because if the Bank of Canada can't cut, can't hold, and can't rise interest rates, then what's next? The truth is, this is where you come in. The central bank can't fix housing supply. They can't lower grocery prices, and they can't stop global inflation from spilling into Canada. But what we can do is take control of the parts that affect us directly. For homeowners, that means being proactive. If your mortgage is renewing in the next year or two, don't wait. Run the numbers early, because the difference between preparing and panicking could be thousands of dollars a month. If you're sitting on a variable rate, explore your options. If you're fixed, see if restructuring or extending your amortization makes sense. For renters, stay alert. Many landlords are underwater right now, and that could turn into opportunity. Some of these properties will hit the market. And for first-time homebuyers, don't tune out. While the headlines sound scary, a lot of these nightmare scenarios are actually creating entry point, especially for first-time homebuyers and people looking at starter homes and smaller markets across Ontario. This could quietly be the window that you've been waiting for. For investors, it's time to pivot. The days of easy appreciation are gone. Cash flow matters again. Focus on fundamentals. And remember, markets move in cycles. This isn't permanent. Eventually, rates will come down, not because the Bank of Canada wants to cut, but because the economy will force their hand. When that moment comes, the people who prepare, who manage their cash flow, reduce debt, and stay informed will be miles ahead. Because here's the truth. Whether the Bank of Canada cuts, holds, or rises, you still have choices. You can review your mortgage strategy. You can refinance. You can protect your cash flow. You just need to act before you're forced to. So yes, the Bank of Canada is in a nightmare scenario, but you don't have to be. You just need the right plan, the right advice, and the right people in your corner. That's exactly why I make these videos, to help Canadians navigate this mess with confidence instead of fear. If you found this helpful, hit subscribe, hit the like button so that we can continue to make more videos like this for people like you. If you want more in-depth, clear information, there's a link in the description that allows you to book a 15-minute call with me. Because no matter what the Bank of Canada does next, the best strategy is the one that protects you. Stay informed, stay ready, Thanks for watching, and I'll see you in the next video.